I'm very pleased to be back in this forum. I've been attending the Extreme Media events since the very beginning. I think I was lucky to actually attend the first one, so I think. So even though I haven't come to every one, but I've attended quite a few, and I'm certainly very impressed by the improved quality of the event, by the improved quality of representation, the level of discussion, and of course the due credit for that goes to Extreme Media team, Alexandru, Sergio, Daniela. So congratulations on bringing the forum to the sort of 20th edition and keeping the quality higher and higher every time. So keep on the good work. Now, while in the past most of my presentations focus mainly on PAID and NatCat insurance, and most of you know me as NatCat sort of insurance expert. This year, due to the rapidly changing regulatory landscape in the Romanian insurance market, such as introduction of the tariff caps and their recent expiration, enactment of the new amendment to the MTPL law by the Parliament, publication of the reference tariff regulation, I have decided to dedicate my speech to the estimated impact of these regulatory changes on the development of the Romanian market at large, in light of international experience. I know it's a very hot topic, very political topic. So, and the reason, of course, for that, as has just been mentioned by Adrian Marin, is that MTPL accounts for such a big share of the market that every time there's a small change in regular treatment of that market, the whole market feels the major impact. So although the first quantitative impacts of rate caps introduced last year will be only known later with the release of claim statistics for the current year and future years, based on international experience, one can expect an adverse impact of this legislative measure on the technical results for the MTP line of business as a class, reduced overall profitability of the sector, and the erosion of the company's capital base. International experience suggests that tariff capping measures bring about the results which are quite opposite to those intended by the legislators, which typically pursue social goals. In brief, the adverse outcomes of such regulatory measures manifested themselves in other countries in the worsening claims performance of insurance companies through low average claim payouts, and I think this has been already shown by, in general, by several markets where that happened. Reduced availability of coverage, access and convenience of insurance coverage, and extended claim settlement time and claims documentation requirements. All of this actually are not good for consumers, because in the end, the biggest and the best thing consumers can expect from insurance companies is to have their claims paid in full and quickly. And if that doesn't happen, so the price that they paid for the policy is somewhat irrelevant, whether it's 10 euros more or less, but if you can't collect on your claim, that's a big problem. And that's, in many respects, what constitutes the main concept of consumer protection when it comes to supervision globally. However, what is even more fundamental is that the rate capping undermines the fundamental role played by the insurance industry worldwide to act as a market-based risk-reducing mechanism for society at large through risk-based pricing. High risks, be it young, inexperienced drivers or reckless commercial truck operators, are kept in check and forced to gradually improve their driving record under the pressure from higher premium rates. In the absence of risk-based pricing, a difference between good and bad drivers can no longer be discerned, which encourages proliferation of risky driving and makes society less safe as a whole. In addition, no industry can supply goods or services below cost, and insurance is no exception. When the cost of MTPL claims, combined with typical average administrative costs and different premium taxes, exceed the premium intake because of the rate caps, the line of business loses its financial sustainability and can no longer be maintained by market operators. However, the above described general economic rationale for not capping insurance rates should also be considered by policymakers in the industry in a more nuanced context that takes into account the problem of highly risky drivers, bad risks. And I think this is the main concern of the SFA. which often cannot find coverage in the insurance market due to their high risk profile. Often rejections of such drivers by insurers manifest themselves in artificially high premium rates quoted for such risks, or outright rejection of requests for insurance coverage. So as MTPL insurance is compulsory insurance coverage, having such bad risks go without insurance becomes a public policy concern, which has been addressed in different ways in EU countries. So while I don't have the comprehensive collection of EU practices, since I had very limited time for this presentation, I looked into several country approaches to how to deal with bad risks. In Austria, in the past, there was an undesirable risk pool for poor quality risks, which was composed of all companies writing motor business and administered by the Insurance Association. Since all risks, even taxis and canceled drivers, can now find cover without difficulty, so the pool has been canceled. So, however, Insurance Association can still allocate an undesirable risk, the one that's been refused by 3 companies, to an insurance company chosen on a rotating basis, and then for a surcharge of 50% and a deductible of once a year premium. In Belgium, and I believe Belgium is sort of like the closest model that sort of Romania sort of had in mind. In Belgium, those drivers who have been marginalized by the increased selectivity of insurance companies are granted a right to insurance, with the establishment of a rating bureau to which all third-party motor insurers must belong. Once a motor risk has been rejected 3 times, the proposer has the right to be accepted by the bureau, and the law also establishes certain maximum levels of premium and deductible which may not be exceeded. So France, the Central Rating Bureau is authorized in several articles of the Insurance Code to deal with the cases of motor third-party liability where insurer has declined to cover the risk. In such cases, the Bureau has powers to impose a suitable premium, rate, and a deductible. And insurer after that can no longer decline that risk under the risk of losing the license. In Germany, German companies are free to set their own motor rates, and they cannot decline any bad driver, although they can charge the price they see fit. Finally, in Italy, there is no bad risk pools, although the possibility of such a pool has been discussed, but there were no further developments. Insurers are not permitted to decline a bad risk, although they may charge an excessive premium in order to deter the proposer. So such action has been increasingly prevalent, particularly in the south of the country, and has resulted in protests from consumer groups, sort of not dissimilar to what you had here. Anyway, as you can see, EU member states have adopted quite different approaches to dealing with bad risks, but all of them converge on 3 main principles. One is that there is no capping of the premium rates for good, that is, non-bad risks. Rejection of bad risks is not an option for an industry. These risks have to be accommodated in a compulsory line of business, although could be at a capped rate. And there are always administrative or industry-adopted solutions for dealing with the placement of bad risks. Now let's talk about the Romanian case. And this is also based on my very preliminary estimate of the regulatory impact of the current legislation, and so I might not be entirely accurate, so please forgive me if I missed a few things. I only had a few days to look at it. So in September 2016, in response to the perceived lack of affordable coverage for risky drivers, that is mainly international transporters, the government introduced an emergency decree Ordinance Law number 54 that came into force in November 16. The law, detailed through an SFIAR regulation, introduced temporary tariff caps on all classes of vehicles, enacted a change in bonus-malus classes, reducing them from 14 to 8 classes, and considerably extended the scope of MTPL coverage. Last week, the caps expired. At the same time, the Parliament passed an amendment to the MTPL law, which is yet to be promulgated by the President, which introduces a reference tariff calculation formula, caps administrative and acquisition costs at 25%, including taxes for tariff calculation purposes, defined bad risks now defined as an insured person for whom at least 3 insurers offer a price higher than a reference tariff multiplied by N factor, with the N being a value which is defined by BAR, the Green Card Bureau, for each respected risk cluster, but is subject to SFA approval. Introduces a bad risk allocation framework for the BAR, including allocation rules, mandates direct settlement to be in place, up to the discretion of consumers, and envisages the possibility to set up a state insurance company in 12 months after the adoption of the law if the market is unable to cope with consumer requests for affordable coverage. So the new proposed amendments to the MTPL law works in tandem with the SFIAR reference tariff regulation published on May 17. The regulation introduced a reference tariff for all major risk classes. While not directly binding, the reference tariff will have a formal capping effect on the premium rate charged to high-risk groups of drivers for both personal and commercial vehicles through the introduction of the maximum N factor to be set by the bar and approved by SFIAR. The risk capping effect for the bad risks will also be felt from the new risk classifications adopted by SFIAR in the calculation of the reference tariff for different risk classes. A brief assessment of these new legislative and regulatory changes indicates that the objective of the legislation goes beyond ensuring availability of MTPL insurance coverage for bad drivers only, on economically acceptable terms through a combination of bad risk allocation mechanism, the reference tariff, and N factor. The amendment of the law contains some explicit tariff capping elements and puts additional pressure on the insurance costs, which will have implications for all risk classes, not just bad drivers, meaning that the rates are going to go up for everybody. The law also creates an opening for the creation of a state-run insurer, which will have a highly distortional impact on the insurance market and will lead to considerable fiscal exposure of the government to mispriced MTPL insurance risk, which is also not good, as you can imagine. Since the draft law still has not been signed into law by the President, so I therefore was wondering whether there will be enough consensus on the part of SFIAR and the industry to remove from it a reference to the capping of administrative costs to avoid having it contested again by the EU Commission and the industry. Even though expenses constitute a considerable part of insurance costs, none of EU member states adopted such caps on expenses or any other tariff caps except for high-risk groups. In the case of the reference tariff regulation, I would also urge SFIAR to work with the industry to synchronize the definition of the risk classes to make sure that they're consistent with each other, the ones on the SFIAR side and that on the industry side. I also think that it is worthwhile to consider reinstating the older, much broader range of penalties and awards in the bonus-malus system, which has played an important role in encouraging responsible driving behavior by the Romanian drivers. With 95 fatal accidents per million inhabitants, Romania is currently at the top of the list in terms of high road fatality rates, making it the least secure country for driving in the EU. The current restriction of penalties for bad risks would motivate hiring of non-experienced drivers, which will be less paid, in the case of corporate risks, with the expected outcome being deterioration in industry technical results and increased cost of MTPL coverage for all risk classes. Hence, a return to a much wider bonus-malus system corridor will be a welcome step forward, or back. And finally, I would like to conclude by bringing your attention to one more important point. In Romania, potential underpricing of risk, encouraged by either legislative or regulatory means in the absence of fully implemented Solvency II requirements, is likely to motivate aggressive market players to expand their market share without sufficient capital or insurance capacity, with all adverse implications for the market solvency. This is not the case in other EU countries, where the EU Solvency II applies fully and insurers are required to have sufficient capacity regardless of the premiums charged. So I think with this, I will conclude my short analysis and will be happy to respond to questions. Thank you.